We have Troy Niehaus joining us from Bernstein, and
Hello.
80 has been a sponsor of ours for the last couple of years, and they've been our deal screening sponsor, which has been great, but we've missed seeing them on a monthly basis for our screening. So I'm very excited to have Troy give us a little bit of a public market outlook and trends here as we go forward. Thank you, Troy. How are you doing today?
I'm doing good. How are you?
I'm good. I'm good. It's glad to see you. So I'm going to turn it over to you, and you have the floor. So I'm going to stop share, and you can share your slides.
Thank you so much. Nice to see you. And can everyone see my screen?
We sure can.
Fantastic. So
yeah.
I know a lot of you out there, and I wish I could see you all in person, but like everyone else, we're stuck doing this. But today I'm going to give an update on what's happening in the economy and the markets and our advice to clients. And
Troy, can you turn on your video?
Yeah, it should be on, I thought. Let me double check.
There you are. Now I see your video.
Now you see me?
Yeah.
Yay, thank you. So let's get started. And if you have any questions, feel free to reach out to me afterwards. You can call me or email me, and I'm happy to answer any questions that you might have. One of the first things that I want to address is what's happening to the market and the economy, and why are they so different? Sometimes we'll get clients asking us, why is the market different than what's happening in the economy? And the simple reality is that the economy is a leading indicator. It's pricing in the most likely outcome, which is a gradual improvement back towards some semblance of normal in 2021. And so there have definitely been a few winners, while I would say the rest of the market is having bounced back from the lows this year, are either flat or still down year to date. As I speak, the market is down about 3.6% over the last 5 days. And our advice is that balance still remains the key to success. Now, to be sure, the economic rebound is undeniable. And on this page, we walk through 6 monthly traditional economic data points to illuminate this improvement. So starting from top left, the unemployment rate has been trending down, now at 7.9%. Weekly jobless claims have been trending down. Retail sales month over month are back to pre-pandemic levels. On the bottom left, manufacturing index is back in expansionary territory above 50. Housing starts month over month are up. A little bit of a dip in August, but they're still up. And finally, on the lower right, small business optimism is trending upwards. And so those are all positive effects in the economy. But I would also say that, we've been taking a look at some other data points. Here we make the same point with higher frequency alternative data sources. They're big data sources. Were used to compile things like credit card transactions on the left, mobility data on the top right, and restaurant reservations on the bottom right. All have shown an improvement, which is what the markets have focused on. And it proves that the economy is healing and opening back up. Now, we do have to point out that there appears to be some inconsistency with what many of our clients, and probably you all, are seeing on TV and in our own communities. New filings for jobless claims in the US totaled 787,000 last week. That's near the lowest total since the early days of the pandemic. Economists have been expecting around 875,000 for the week ending October 17th. And it was the lowest total since October 3rd. And it's the second lowest market since March 14th, just before the avalanche of layoffs that followed the shutdown efforts to combat the coronavirus. After gaining about 661,000 workers this month, the economy has added now a total of roughly 11.5 million jobs since the trough in April. And that's just over half of the 22 million jobs that were lost. At this month's run rate, its peak, it would still take more than a year, I think, however, to regain the prior peak in employment. And of course, there are and will continue to be new entrants to the labor force that need to be absorbed as well. There's still a very long way to go. And as the labor market continues to improve, I mentioned that it's fallen down to the unemployment rate anyways to about 7.9%. Our expectation is that we'll see additional improvement, but the pace is going to slow. We recognize that some perspective is necessary, and certainly it's helpful to not overstate the significance of what we're seeing and feeling. So we put together the next couple pages to take a deeper look at a few things. Here we have two pie charts. So one on the left shows industry share of US GDP, and the other on the right is the same, but for the labor force. And what you see in both is that the troubled sectors only make up about, on the left, about 10% of the GDP, and then on the right, about 20% of the labor force. And those troubled sectors are what you would expect: retail trade, restaurants, entertainment like movie theaters, airlines, and so on. So while it's, so while it's totally accurate to highlight the headwinds facing these particular sectors, their significance shouldn't be overstated. We also don't want to imply that the other 80 to 90% of the economy or the labor market are unaffected. They certainly are, but they're definitely in a much different place now. As we look at the market, you probably all know that earnings per share make up most of what the market returns are. And 2020 is obviously being punished by the shutdown, but with the economy continuing to open back up, earnings look set to rebound next year and beyond. Since earnings are the main driver of the market performance, the recovery and profitability has led the market higher. This year, we're down about $131 a share. That's revised upward from, I think, original estimates were closer to around 119 back in March and April. But remember, the market's a leading indicator. So 2021 is what's being priced in today. We're at about $165 a share this year. And if you look back to pre-COVID 2019, it's still a little bit higher. And then, of course, 2020, $190 a share looks a lot better. As you take a closer look here in this chart, we can actually see what components of the market have done well and not so well. So most sectors are either flat or still negative, with the only true success being US growth. There on the far right, you can see year to date, it's up about 24%. So let's take a look at the US market to see exactly what has driven the success. So here, you can see on the left, the top 5 companies by index weight have significantly outperformed the overall market and now make up, on the right, you can see about 25% of the S&P 500 index. Before, if you look back in early on the chart there on the right, about 90, 91, 92, it made up only about 12%. So it's significantly higher today. And these are primarily the FANG stocks, the Facebook, Amazon, Apple, and Google. I'm substituting Microsoft for Netflix because of the market cap. But this doesn't truly tell the story of what's happening in the S&P. This chart certainly, I think, puts it more into perspective. If you weighted every company in the S&P, it would actually be below where the index is right now. So it's definitely still struggling. Now, you might have the question is, what's the impact of the election going to have on the markets? We're getting that question from so many of our clients today. And we know that there is certainly very little long-term impact on equity markets unless they coincide with or contribute to a recession. So given where we sit today, the most likely link will be via a fiscal policy. Now, of course, the election is just 6 days away. So we have to keep in mind that we may not find out who the winner is for quite some time. Now, looking at this chart on the left, during the past 5 years, the 30-day average for volatility is just under 1%. Now, this means up or down in terms of volatility. When we look at the last 2 elections, well, actually before that, if we look, first of all, the middle one there where it says 1.3%, that's where we've seen an increase over the last month. And then when we look at the last 2 elections there in green, it jumps up to about a 1.7%. And you compare this with the market's implied volatility for this November, we're seeing a jump of over 3 times. And some are certainly fearing a contested election. It's a pretty safe bet, I'd say, that much of the volatility is due to the uncertainty that we may not know who won the election for quite some time, and possibly that it may become a disputed election. So if you look on the chart on the right, it shows equity returns for US, global, and developed international stocks. and both U.S. and global investment grade bonds during the last contested election in 2000 with Bush v. Gore. That period of uncertainty lasted from Election Day on November 7th through the recount and the Supreme Court looking at it until Bush was named president-elect on December 12th. So you can see that the max drawdown for stocks from around 7 to 8%, and you can see that bonds certainly did their job to offset the equity risk and posted positive returns. So coming back to this year's election, what can we expect? While there certainly are some things that we know, there are also some things that we don't know, and we may not know for quite some time. So we don't recommend any asset allocation changes in portfolios, but we know that we are certainly poised to take advantage of many opportunities that market volatility presents. So there are competing visions, I think, both for Biden's platform and for President Trump's platform. Here you can see where each candidate stands regarding taxes, trade, healthcare, and infrastructure. Looking at just taxes, Biden has said that he'll raise the corporate tax rate. He said that he'll increase taxes for those making above $400,000 and he'll also tax capital gains as ordinary income for those with AGI above $1 million. President Trump has said that he'll extend tax cuts beyond 2025 and has proposed a COVID stimulus that will cut payroll taxes that currently fund Social Security and Medicare. So looking at the two main areas that investors are currently expecting some possible changes, that would be multi-year fiscal stimulus and easy monetary policy. There's no question really about what different election outcomes might mean for investor confidence in this continued policy support. So markets tend to prefer as little government interference as possible, but we do know that it's different this time since the consensus is that we need broad fiscal policy support. So the two gray boxes in the upper right and lower left represent split party votes. There could be a lack of willingness to give the other side a win considering fiscal policy support, and that certainly could create obstacles